What if you could help your kids move into the home you raised them in, skip PMI and the bank of mom and dad drama, and actually see your wealth make a difference, while staying in control and never writing a single check? There's a powerful strategy that makes this possible, and most families don't even know it exists. It's called a gift of equity. And it's not just a clever mortgage trick. It's a living wealth transfer tool that helps your family right now, not just after you're gone. In this video, I'll show you exactly how it works, walk you through the benefits and paperwork, and flag the hidden traps that can create family friction if you are not careful. Think of it like this. You are not handing your child a briefcase full of cash. Instead, you are giving them equity, the value you've already built up in your home over the years. Here's how it works with real numbers. Let's say your house appraises at $800,000, but you sell it to your daughter for $640,000. That $160,000 difference, that's considered gifted equity, and lenders treat it exactly like a down payment. Your daughter walks into the bank with a purchase contract for $640,000. The lender orders an appraisal showing it's worth $800,000, and boom, she now has 20% equity without bringing any cash to closing. No private mortgage insurance, better loan terms, and she's a homeowner in the house where she grew up. Now here's why this destroys the traditional family loan approach. Most parents think they are being generous by loaning money at 0% interest, but the IRS sees that as a gift of the foregone interest, about $6,600 per year based on June 2025 midterm applicable federal rate of 40.7%. Now you are dealing with imputed income calculations, potential gift tax filings every single year, and a paperwork nightmare that never ends. With gift of equity, you file one gift tax return and you are done. Clean, simple, and the IRS actually prefers it. And here's why this matters more than ever. While most parents watch helplessly as their kids get priced out, your equity lets you rewrite the rules, turning today's impossible market into their extraordinary advantage. While other buyers fight over 5% down payments, your child walks in with 20% equity. No cash, no PMI, no generational wealth lost to rent. That said, this isn't a one-size-fits-all solution, but it shines in 4 specific scenarios. Number 1, parents helping children stay in their family home. You are ready to downsize anyway, but your child wants to stay in the neighborhood where they grew up, keep the kids in the same schools, and preserves those family memories. Number 2, grandparents helping the next generation. Instead of waiting for your estate to distribute money decades from now, you get to see your wealth solve real problems today when your family actually needs it. Number 3, keeping cherished property in the bloodline. Think vacation homes, farmland, or multi-generational properties. Instead of selling to strangers, gift of equity keeps treasured property in the family intentionally. And number 4, divorce settlements where one spouse stays. One spouse keeps the marital home but needs to buy out the other. Gifted equity can cover that gap without requiring new cash from extended family. Let's talk about why this strategy is so compelling for families like yours. Number 1, it eliminates the down payment barrier. Your gift can cover the entire down payment and help your child avoid private mortgage insurance, potentially saving them $200 to $400 per month. That's real money that stays in their pocket. Number 2, immediate wealth transfer with visible impact. This isn't just about money. It's about stability in a volatile market. You just moved $160,000 of value to your child while you're alive to see how it changes their life. Instead of them inheriting money they might not need decades from now, you're solving a real problem they are facing today. 3, faster, cleaner transaction. No real estate agents, no marketing period, no competing offers, no inspection surprises. It's a private transaction with a set closing date that works for everyone involved. Number 4, emotional rewards that money can't buy. You get to see your grandchildren playing in the same backyard where you raised their parent. You preserve family traditions and memories in a way that pure inheritance never could. If you are thinking this might be the right move for your family, it's worth taking the next step. A gift of equity can be a powerful way to support your loved ones, but only if it's a part of a plan that actually works for you. If you'd like to walk through how this could apply to your situation, there is a link below to schedule a short meeting. We'll learn more about your situation, talk through the numbers, and see whether this kind of planning is the right fit. No pressure, just a thoughtful conversation to help you move forward with clarity. Here's where families get into trouble. They think this is just a handshake deal between relatives. Wrong. You need 4 critical pieces of documentation done right. Number 1, a formal gift letter stating the exact amount of equity being gifted, confirming no repayment is expected, and documenting your relationship to the buyer. This isn't optional. Lenders require it. Number 2, an independent appraisal. The lender must verify you are actually selling below market value, not inflating the price to create fake equity. The appraiser can be your neighbor's cousin. It needs to be legitimate. Number 3, proper gift tax filing. If your equity gift exceeds $19,000 in 2025, you need to file Form 709. You probably won't owe any tax because it just uses part of your lifetime exemption. But skip this filing and you could face penalties down the road. Number 4, understanding the basis carryover trap. Here's the hidden issue. Your child takes on your original cost basis in the property. If you pay $200,000 and they later sell for $900,000, they are looking at capital gains tax on $700,000. Compare that to inheriting the property at your death, where they'd get a stepped-up basis and owe nothing. This strategy isn't perfect, and there are real landmines that can explode family relationships. Number 1, the sibling equality crisis. The moment you sell the family home to one child, your other kids are going to have strong opinions. You need a plan to equalize, whether that's life insurance benefiting the other children, adjusting other inheritances, or making matching gifts of liquid assets. Number 2, Medicaid timing complications. If you need long-term care within 5 years of this transaction, that below-market sale could disqualify you from Medicaid coverage. This doesn't mean you can do it, but timing and health considerations matter. Number 3, your own financial security. Selling at a discount means you pocket less cash for your own downsizing or retirement needs. Make sure this generous move does not compromise your own financial independence. And number 4, appraisal disappointment. If the appraisal comes in lower than expected, there's less equity to gift, potentially forcing your child to bring cash they don't have or renegotiate the entire deal. If you're considering this strategy, here's how to navigate it successfully. Number 1, start with a professional appraisal. Not Zillow, no guesswork, real numbers. Number 2, involve a qualified lender early in the process. FHA, VA, and conventional loans all allow equity gifts, but each has different documentation requirements and timing. Get them involved before you set any closing dates. Number 3, run the capital gains math carefully. Know the trade-off between gifting now versus inheriting later. Sometimes waiting is actually the smarter financial move. Number 4, document everything. You will need the gift letter, settlement statements, independent appraisal, and possibly a gift tax return. Keep it all. Number 5, address sibling fairness upfront. Whether it's life insurance, trust adjustments, or other assets, have the equalization conversations with all your children before you act. Clarity prevents conflict. Number 6, think big picture. How does this gift fit into your overall retirement security, long-term care planning, and other legacy goals? Don't let one generous move derail your broader financial plan. A properly structured gift of equity can put your children in the family home, save them real money every month, and let you witness your wealth making a meaningful difference. But only if you handle the documentation, tax implications, and family coordination the right way. This isn't a DIY project. The gift tax rules, lender requirements, basis considerations, and family dynamics all need professional coordination with your CPA, mortgage professional, and estate planning team. But when done right, you get to see your legacy living and breathing in the form of your children and grandchildren thriving in the home where it all began. And honestly, that kind of generational continuity and family stability, that's what real wealth is all about. Now that you understand how gift of equity works, you might be wondering what other wealth transfer strategies could help your family. The truth is, gift of equity is just one of 15 powerful strategies I've seen work for families like yours. Watch this video where I break down all 15 approaches so you can see which combination might work best for your situation.